Warren Buffett has held Coca-Cola stock for over 35 years. Apple, he's been holding since 2016 and refuses to sell. But here's what nobody tells you. Even Buffett sells stocks. And when he does, there's always a reason. Most investors lose money not because they buy the wrong stocks, but because they sell at the wrong time. Or worse, they hold when they should have run. So when does the Oracle of Omaha actually hit the sell button? Today, we're breaking down the 3 times Warren Buffett says you should sell a stock. And trust me, the third one will surprise you. Let's dive in. Lesson 1. When the fundamentals have permanently changed. Here's the truth. Companies change. Industries shift. What looked like a gold mine 5 years ago can turn into a sinkhole today. And Buffett's rule is simple. If the core reason you bought the stock no longer exists, it's time to sell. Let me give you a real example. In the 1990s, Buffett invested heavily in a shoe company called Dexter Shoe. He loved it. The company had strong margins, consistent profits, and seemed bulletproof. But then, foreign competition flooded the market, cheaper shoes, better distribution, and suddenly Dexter couldn't compete. The fundamentals crumbled. Buffett held on too long. He later called it one of his worst investments ever. Cost him billions. The lesson? When the business model breaks, you don't hope it fixes itself. You get out. Now, let's be clear. This isn't about short-term noise. Stock drops 10%. That's not a reason to panic. CEO steps down. Doesn't always matter. A bad quarter could be a blip. But if the moat is gone, sell. Think about it like this. Imagine you own a restaurant. For years, it's the best barbecue in town. Lines out the door, but then 3 new barbecue spots open up. All cheaper, all just as good. Your customers start disappearing. Do you keep pouring money into that restaurant hoping people come back? Or do you cut your losses and move on? Buffett says, move on. Here's how to spot when fundamentals have changed. First, competitive advantage is eroding. If competitors are eating your company's lunch, that's a red flag. Look at market share. Are they losing ground? Are customers switching? That's your signal. Second, management starts making desperate moves. Mass layoffs, weird pivots, selling off core assets. When leadership panics, it's usually for a good reason. Smart CEOs don't burn the furniture unless the house is already on fire. Third, the industry itself is dying. Newspapers, Blockbuster, Kodak. Sometimes it's not the company's fault. The world just moved on. And when the tide goes out on an entire industry, even the best swimmers can drown. Buffett himself has said, should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. Translation, don't go down with the ship. Here's a perfect modern example. IBM. Buffett bought big into IBM starting in 2011. He loved their enterprise business, their cash flow, their dividends. Classic Buffett stuff. But then the world shifted. Cloud computing exploded. Amazon Web Services and Microsoft Azure started dominating. And IBM, they were slow. Too slow. By 2017, Buffett started selling. By 2018, completely out. He admitted the business wasn't what he thought it was. The competitive landscape had changed, and IBM was getting left behind. That's not weakness, that's wisdom. So here's your action step. Go through your portfolio right now. For each stock, write down why you bought it. Be specific. Was it growth potential, market dominance, innovation? Then ask yourself, is that reason still valid today? If you're making excuses or hoping things turn around, that's your answer. Time to sell. Lesson 2. When you made a mistake. Let's talk about ego. Most people refuse to sell a losing stock because it means admitting they were wrong. They'd rather watch it bleed to zero than accept the mistake. Buffett, he does the opposite. When he realizes he's made a mistake, he sells fast. No hesitation, no ego, just logic. One of his biggest examples, Tesco, the British supermarket chain. Buffett bought in around 2006. For years, it looked solid, steady cash flow, reliable business, classic grocery store moat. Then things started falling apart. Accounting scandals, profit warnings, brutal competition from discount chains. The stock tanked. By 2014, Buffett realized this was a mistake. I was wrong about this company. So what did he do? He sold. Took a huge loss, around $444 million. But here's what he said about it. Thumb-sucking did not help. When you find yourself in a hole, stop digging. That's the mindset. You don't double down on a bad decision. You cut it loose and move forward. Now, here's where most investors mess up. They confuse a losing stock with a bad investment. A losing stock just means the price went down. A bad investment means you were wrong about the company from the start. Big difference. If you bought Tesla thinking it's a tech company revolutionizing energy, and it still is, a 20% dip doesn't make you wrong. That's just volatility. Markets do that. But if you bought a company because you thought they'd dominate their industry and now they're getting crushed by competitors, you were wrong. Sell. Buffett has a great way of thinking about this. He says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Translation? If you bought a mediocre company just because it was cheap, and it turns out to actually be mediocre, don't hold on hoping it becomes wonderful. It won't. Cut your losses. Redirect that capital into something better. Here's the hard truth. The market doesn't care what price you paid for a stock. It doesn't care that you're down 30%. It doesn't owe you a comeback. That's called anchoring bias. You're emotionally attached to your purchase price, but the market doesn't know or care about your cost basis. So ask yourself this. If you didn't already own this stock, would you buy it today at the current price? If the answer is no, sell it right now. Let me give you another Buffett example. US Air. He invested in the early 90s, thought the airline industry would stabilize. It didn't. Operational nightmares, price wars, terrible margins. Buffett called it one of his dumbest investments. He even joked, if a capitalist had been present at Kitty Hawk, he should have shot Orville Wright. But he didn't hold on out of pride. He sold, learned his lesson, and moved on. And here's the beautiful part. Because he cut his losses early, he had capital available to invest in better opportunities. That's how you build wealth. Not by being right all the time, but by limiting your mistakes. So here's your second action step. Look at every losing position in your portfolio. Be honest with yourself. Was I wrong about this company? Did I miss something fundamental? If the answer is yes, swallow your pride and sell. You'll thank yourself later. Lesson 3, when you find something better, this is the one that surprises people. Buffett doesn't just sell when things go wrong. Sometimes he sells when things go right because he found something even better. It's called opportunity cost. And it's one of the most overlooked concepts in investing. Here's how it works. Every dollar you have invested in stock A is a dollar you can't invest in stock B. So even if stock A is doing fine, if stock B has way more potential, you sell A and buy B. Buffett does this all the time. In 2020, he sold his entire position in airlines. United, Delta, Southwest, all of them. Was it because airlines were terrible companies? Not exactly. It was because COVID had fundamentally changed the business, and he found better places to put his money. Where'd that money go? He doubled down on Apple, bought more Bank of America, invested in new opportunities with better long-term prospects. That's strategic selling. Now, most investors never think this way. They hold stocks forever because it's still going up, or I'm in the green. But going up isn't enough. The question is, compared to what? Let me break this down with a simple example. Say you own a stock that's grown 8% per year. Not bad. You're making money. But then you find another company, better management, stronger growth, clearer competitive advantage that you believe will grow 20% per year. What do? Most people hold both. They don't want to sell the winner, but Buffett, he'd sell the 8% stock and put everything into the 20% stock because opportunity cost is real. That 12% difference compounds massively over time. Here's the math. $10,000 at 8% for 10 years becomes $21,589. Not bad, but $10,000 at 20% for 10 years, that's $61,907. That's a $40,000 difference, all because you made one smart swap. Now, I'm not saying chase returns recklessly. You need to be confident in your analysis. But if you genuinely believe you've found a superior investment, don't let attachment to your current holdings hold you back. Buffett calls this moving from good to great. He's done it repeatedly. He sold Freddie Mac to buy more Wells Fargo, sold PetroChina after it had a massive run to reinvest elsewhere, even trimmed positions in companies he loves like Coca-Cola when valuations got stretched and better opportunities emerged. And here's the key. He's not trying to time the market or chase hot stocks. He's simply asking, where will my money work hardest over the next 5 to 10 years? Let me give you one more example. In the late 90s, Buffett was criticized for not buying tech stocks during the dot-com boom. Everyone thought he was missing out, but he stuck to his circle of competence. He held companies he understood, boring stuff like insurance and consumer goods. Then the bubble burst, all those tech darlings crashed, and Buffett, he had dry powder ready. He went on a buying spree, scooping up incredible companies at discount prices. That's the power of knowing when to sell and when to wait for something better. So here's your third action step. Rank your portfolio. Put your holdings in order from most confident to least confident. Then ask yourself, if I had fresh cash today, would I buy my bottom 3 holdings? Or would I put that money into my top 3? If the answer is the top 3, sell the bottom 3. Consolidate your winners. Put your money where your conviction is strongest. Practical takeaway. All right, let's bring this together. 3 times you should sell a stock, according to Warren Buffett. 1, when the fundamentals have permanently changed. The moat is gone. The competitive advantage disappeared. The industry shifted. Don't hope for a turnaround. Sell. 2, when you made a mistake, you were wrong about the company. The thesis didn't play out. Your analysis was off. Cut your losses fast and move on. Ego is expensive. 3, when you find something better. Opportunity cost is real. Your money should always be working its hardest. If you find a superior investment, don't be afraid to upgrade. Now, here's what I want you to do this week. Sit down with your portfolio. No distractions, no excuses. For each holding, answer 3 questions. Is the original reason I bought this stock still valid? If I didn't own this, would I buy it today at the current price? Is there a better opportunity I'm missing because my capital is tied up here? Be brutally honest. Write it down. If any stock fails these tests, start planning your exit. You don't have to sell everything tomorrow, but create a plan. Set a price target, decide your timeline. Because here's the reality, holding a bad investment doesn't make you patient, it makes you stuck. And Buffett didn't become a billionaire by being stuck. He became one by making smart decisions, including knowing when to let go. So here's the big insight. Selling isn't about giving up. It's about being smart with your capital. Buffett's strategy isn't complicated. Buy great companies. Hold them as long as they stay great. And when they stop being great, or when you find something better, have the courage to move on. Most investors lose money not because they can't pick stocks, but because they can't let go of bad ones. Don't be most investors. If this video helped you think differently about selling stocks, hit that like button. Subscribe for more investing breakdowns and drop a comment. What's one stock you've been holding too long? Let's talk about it. Remember, your portfolio should work for you, not the other way around. Now go audit your holdings, and I'll see you in the next one.